Today, I'll talk about two interesting stories. In the first one, I talk about what does it really take to dig underground tunnels, and in the second one, I talk about chemical sector's trade problem. Welcome back to the Daily Brief show by Zerodha, where we cut through the news to help you understand what's actually happening in the most important stories from business and markets. I'm your host Krishna, and today is Monday, 27 July. This spring, workers at Gansoli in Navi Mumbai lowered the last parts of a massive machine into a shaft underground and assembled it there. This machine is longer than a football pitch, about as tall as a 4-story building, and it weighs more than 3,000 tons. On 18th of July, the machine began its journey towards Vikhroli, boring a 10-kilometer tunnel that will eventually pass under the Thane Creek. It will become India's first undersea railway tunnel. 13 days earlier, a second machine had started digging from Vikhroli towards Bandra Kurla complex, passing beneath some of Mumbai's busiest neighborhoods. These are the two tunnel boring machines building the underground section of the Mumbai-Ahmedabad bullet train. Over the next few years, these two machines will dig through kilometers of earth that no one has ever seen before. But why build a railway underground at all? Wouldn't it be simpler to build it on the surface? Now it would, but sometimes the surface simply stops cooperating. Trains can't climb steep slopes or take sharp turns. They need gentle gradients and wide curves, and high-speed trains need them to be even gentler. Try fitting that through a city like Mumbai and you quickly run out of space. The route runs into roads, buildings, utilities, water bodies and everything else already sitting on the surface. Take the Mumbai-Ahmedabad bullet train for example. Between BKC and Shilpata, the only practical route runs beneath Mumbai and the Thane Creek. So there isn't much choice but to dig. Now before the digging starts, engineers try to find out what's underground. They drill boreholes, run seismic surveys and study the rock and soil. The International Tunneling Association is blunt about this and says that it isn't just paperwork. This stage decides the route, the depth, the construction method and ultimately the cost. But there's a problem with this process. A tunnel is one continuous line through a huge volume of ground, while boreholes only tell you what's happening at the few places where you drilled. Now everything in between is an educated guess. And sometimes that guess can be wrong. A fault might lie between two boreholes or a layer of water-bearing sand might appear where the model predicted clay. Now that's the reality of tunneling. No matter how much you study the ground beforehand, there will always be uncertainty. Now to do this inherently uncertain job, a contractor has to turn all that uncertainty into a single number. It has to estimate how fast the machine will move, how quickly its cutters will wear out, how much support the tunnel will need, and how many delays might crop up from problems nobody can predict yet. Then it has to put a price on all of that and promise a finish by a certain date. That's why the contract matters so much. It has to clearly define who bears the risk when the ground turns out differently than expected, instead of leaving it open to endless disputes. Now modern underground contracts try to do exactly that. The FIDIC contract for tunneling is built around something called a geotechnical baseline report. Think of it as an agreed description of the ground conditions that the contractor is expected to price for. If the actual ground broadly matches that baseline, the contractor bears the risk. But if conditions turn out to be materially worse, it allows the contractor to potentially claim extra time or money. It also helps the project owner. Without a shared baseline, cautious contractors would bid more than needed to cover for every possible surprise, while aggressive ones would bid low and fight over claims later. Now the project owner doesn't want either. However, the bullet train project doesn't use the specialist tunneling contract. The public tender refers to an older FIDIC contract where the employer provides the design. But the documents that explain how geological risk is actually divided between the two sides weren't made public. They were available only to bidders who paid a fee and signed a non-disclosure agreement. So from the public record, it's impossible to know whether the project uses a formal geotechnical baseline or something similar. Now let's say you've won the contract. You can still start digging. First, you have to build the machine that will do the digging. Before tunneling begins, workers excavate large launch shafts where the tunnel boring machine is assembled underground. Now the machine itself doesn't arrive in one piece. Its parts are lowered into shaft one by one and bottled together below the surface. And despite the name, a tunnel boring machine isn't just a giant drill. The spinning cutter head at the front is only one part of a much larger system. Now behind it are power systems, ventilation, equipment that installs the tunnel lining and all the machinery needed to keep the operation running. Now in other words, it's an underground factory. There are many ways to excavate a tunnel depending on the ground and the project. Here we are only looking at one of them, tunnel boring machines or TBMs. Once the machine is assembled, it settles into a cycle that it repeats thousands of times. The tunnel under Thane Creek is being dug using a mixed-shield tunnel boring machine. It's designed for soft, waterlogged ground where both soil and groundwater are constantly pushing into the tunnel. To stop the tunnel face from collapsing because all this pressure, the machine fills the space behind its cutter head with pressurized and thick mixture of clay and water called slurry. Now this pressure holds the ground in place while the cutter head cuts through the soil. Now the removed soil mixes with the slurry and is pumped to the surface. There, a separation plant removes the soil, cleans the slurry and sends it back underground to be used again. Now the whole process runs in a continuous loop. Not every tunnel boring machine works this way. Some use the excavated soil itself to support the tunnel face instead of slurry. Which process is used depends mostly on the ground. Now as the machine moves forward, it also builds the tunnel behind it. A mechanical arm places the curved concrete segments one by one until they form a complete ring. Hydraulic then pushes against the newly built ring to drive the machine forward. Grout, which is a paste of cement, water and sand, is injected into the gap outside the lining to fill any empty space and reduce the chances of the ground above settling. Now the machine also has to stay on course. It can't see where it's going, so survey instruments constantly compare its actual position with the planned route. If it starts drifting, the crew adjusts the hydraulic to steer it back on line. Now everything we have discussed so far assumes the ground behaves the way engineers expected, but that's often not what happens, and when it doesn't, things can get very complicated. Sometimes the problem is the ground itself, sometimes it's how the machine was operated. Figuring out which one is responsible can take years. In 2019, a tunnel boring machine operated by ITD Cementation was digging underground. Suddenly it got flooded with water and soil as the machine went under Beau Bazaar neighborhood. The ground above sank, houses cracked and collapsed, and residents had to be evacuated. Now the engineering failure soon became a legal battle. The contractor argued that it had encountered ground conditions nobody could have predicted. Kolkata Metro argued that the real problem was how the machine had been operated. Years later, the dispute is still being fought in court. Now that's the tricky part about tunneling. When something goes underground, it's often difficult to know whether the ground surprised the machine or the machine failed to handle the ground. And the answer can decide who pays hundreds of crores in damages. Now the Himalayas present a different challenge altogether. There, the problem isn't waterlogged soil but weak, fractured rock that can't support itself. Engineers still dig the tunnel in small sections, support it immediately and then move forward. But exactly how much support is needed keeps changing. One stretch might need extra concrete and rock bolts. The next might need steel pipes driven ahead of the tunnel to hold the rock together before digging can continue. Now in other words, even with all the planning, tunneling is rarely a fixed process. Engineers often have to adapt meter by meter as the ground reveals what it's really like. If all of that wasn't difficult enough, a contractor can be excellent at tunneling and still struggle as a business. Now the biggest reason is time. Tunneling demands huge upfront spending. Contractors have to pay for machines, launch shafts, equipment and workers long before they earn any money. Even after the work is completed, payment isn't always immediate. Bills first have to be measured and certified, some money is held back, disputed bills turn into claims, and those claims can take years to resolve. That means a contractor can successfully finish a technically difficult tunnel and still have a large part of its money stuck in unpaid bills and legal disputes. HCC, one of India's most experienced tunneling companies, is a good example. It has spent years waiting to recover large arbitration claims. According to the company, most of these disputes weren't even about unexpected geology, but about delays, design changes, and changes in the scope of work. Eventually, the machine reaches the end of the tunnel. This moment is called the breakthrough. It's when the cutter head finally breaks into the receiving shaft at the other end. After kilometers of digging underground, the machine has arrived exactly where it was supposed to. But breakthrough only marks the end of excavation. It doesn't mean that the project is finished. The tunnel still needs tracks, drainage, walkways, power cables, ventilation, signaling, fire systems, and plenty of other equipment. Then comes months of testing before the first train can run. The tunnel boring machine itself has to be dismantled or turned around. And for the contractor, payments may still be pending and claims may still be unresolved. Only much later does the tunnel become what it was always meant to be, just another part of the railway. One day, a train enters at one end and comes out the other. Passengers rarely notice anything beyond a few minutes of darkness. They don't see the years spent studying uncertain ground, the giant machine that built the tunnel ring by ring, or the commercial and engineering risks that made it possible. Now, that's really the goal of tunneling, to turn something incredibly difficult and uncertain into infrastructure so ordinary that nobody thinks about it anymore, except maybe us geeks. Now, coming to the second story. Think about the last time you took paracetamol. Hopefully, that wasn't anytime soon. Or even the last time you wore a nice multicolored t-shirt or painted a wall or wrapped something in plastic. Now, every one of those things needed chemicals as an input somewhere along the way. Pharma needs chemical intermediates for its APIs, plastic and rubber need petrochemical feedstock, textile needs dyes and finishing agents, electronics need solvents and specialty coatings, and fertilizers need ammonia and phosphoric acid. India is the world's sixth largest chemical producer, and the sector contributes roughly 9% of manufacturing gross value added, or GVA. It covers more than 80,000 commercial products, but the sector is a pressure point for the rest of the Indian manufacturing. When something goes wrong in chemicals, it cascades to industries that need it. A new working paper from CSEP tracked about 2,700 firms that use chemical inputs across Indian organized manufacturing and found that the biggest user of chemicals at 29% is the chemical sector itself. Rubber and plastics account for another 18%, pharma 13%, and electrical equipment about 7%. The report goes into what happens when you impose protectionist measures on them. Now, before we start with what the report says, let's take a look at what the industry looks like. India's chemical sector has a well-documented structural weakness. In 2023, the country imported $75 billion worth of chemicals and exported $44 billion, a trade deficit of $31 billion. The highest volume of chemical imports comes from China, which accounts for 30 to 35% of the total. In the subcategory of organic chemicals, which includes pharma intermediates, dye building blocks, and polymer precursors, India imported $11 billion from China in 2024 while exporting roughly $1.2 billion back. Now, the dependency runs deep in its specific product lines. About 76% of India's bulk drug imports by volume come from China. For antibiotics, that figure is closer to 87%. Now, the dependence is both on finished intermediates and the feedstocks that Indian manufacturers need to make intermediates. Now, what this means is that even where India has petrochemical capacity, it's stuck making low-value bulk products rather than moving up the value chain into higher-value derivatives like MDI, fluorochemicals, or battery materials. For instance, India converts 95% of its propylene into polypropylene compared to 70% globally and 75% of its ethylene into polyethylene compared to 63% globally. At the top of the market structure, you have massive integrated players. Reliance operates the world's largest single-site refinery cum petrochemicals complex in Jamnagar. In fact, Gujarat alone produces roughly 40% of India's chemical output. In specialty chemicals, which is the high-growth, high-value segment, companies like PI Industries, SRF, Navin Fluorine, and Aarti Industries have been winning contract manufacturing orders. Now, many of these orders came in the wake of a China plus one narrative. After the pandemic disrupted Chinese supply chains and the Galwan standoff made governments rethink sourcing dependencies, global pharma and agrochemical companies started actively looking for alternative manufacturing bases. Now, India was the obvious candidate. Cost competitive, technically skilled, large domestic market, and increasingly capable of meeting the regulatory standards that European and American buyers require. Now, the China plus one story has been the sector's headline narrative for some time now. But beneath these large and mid-cap players sits a vast MSMEs ecosystem producing the organic and inorganic intermediates that feed the bigger firms. And it's the base layer that's been caught in a regulatory squeeze. Now, our massive trade deficit in chemicals and the flood of cheap Chinese chemicals behind it created a real policy problem. Cheap Chinese imports were undercutting domestic producers by dumping their excess product in India. There were also some quality concerns behind these imports which weren't forced to meet Indian standards the way domestic producers had to. The government needed a tool not just to enforce quality standards on both imports and domestic production, but also bolster the competitiveness of Indian chemical products. Now, that tool was called Quality Control Order or QCO, that we have covered before on the Daily Brief. QCOs are regulations that make BIS certification mandatory for specific products before they can be sold in India. Both domestic manufacturers and importers have to comply. In principle, QCOs are about ensuring product quality. But in practice, they've become one of the government's most used tools for restricting imports. The number of products covered by QCOs expanded from fewer than 70 in 2016 to nearly 800 by 2025. As we have covered before, QCOs are most popularly used in Indian steel. The concerns behind them were similar. Foreign exporters were dumping their excess stock in India and our industry needed protection. However, famously, that story didn't end without trade-offs. MSMEs, which depended on high-quality imports that weren't made in India, were now burdened with high compliance costs. So some of those QCOs were rolled back in late 2025 after industry pushback and a high-level government review. Now, the chemical story is in many ways a sequel, but it's also more revealing because chemicals sit so deeply in the supply chain that the effects are wider and harder to contain. The CSEP paper maps exactly how fast QCOs reach the chemical sector. Chemical-related QCOs went from essentially zero before 2018 to 52 by 2024. By that point, 57% of all chemical-using firms had a QCO on at least one of their imports and two-thirds faced a QCO on either import or output side. From no exposure to majority coverage in 6 years, that's one of the fastest regulatory expansions in Indian manufacturing. Now, the government has since then pulled back though. In 2025, India revoked 33 chemical QCOs across terephthalic acid, ethylene glycol, polyester yarns, and so on. But 28 remain in force and the broader QCO pipeline across sectors still covers hundreds of products. What the CSEP paper does though is go beyond counting QCOs. It tracks what actually happened to the firms that caught in them, using a decade of annual survey of industry's data. The core headline finding of the paper is counterintuitive. QCOs on chemical inputs that firms buy are associated with roughly 10% of increase in production value. Now that sounds like a very good thing, but they have simultaneously associated with a 37% decline in gross value added or GVA. But what's really going on? When QCOs restrict which chemical input firms can source, input costs rise. Firms that can pass those costs through do so, charging higher prices for their output. The production number, which is measured in rupees, goes up. But GVA, which strips out the cost of inputs to measure the actual value being created, falls sharply. In essence, it only made finished products more expensive, which bolstered the top line without adding to productivity. Now, there's a separate question about whether this is a truly casual effect or an association shaped by other factors the regression can't fully capture. And these authors acknowledge this. But the pattern is consistent not only across multiple robustness checks, but as we know now, across sectors. Input QCOs are indeed associated with higher costs flowing through as higher prices with no corresponding improvement in efficiency. QCOs on finished outputs tell an even more uncomfortable story. These regulations are directly aimed at what firms produce using their inputs. The expectation is to improve the quality of finished products, but the authors find no statistically significant effect of QCOs on any measure, be it production, GVA, or profits. The regulations designed to boost Indian manufacturing quality aren't measurably doing that. There's an interesting parallel with what's happening on the capacity side. As per CareEdge, capacity utilization in India's organic chemical segment declined from 73% in FY19 to 64% in FY24. Now dyes and pigments are worse, falling from 78% to 58% over the same period. Now this means QCOs aren't compensating for its domestic supply shortage. India already has underutilized capacity in these categories. The regulations are protecting capacity that isn't being fully used, and the cost of that protection falls on the downstream firms that buy chemical inputs. Most importantly, India's chemical exports haven't yet meaningfully risen just because of these QCOs either. The paper's headline results bode far less well for India's smallest firms. Large and medium-sized firms, which are classified as having turnover above 50 crores, see that 10% production increase from input QCOs, which makes sense. They have the pricing power and the scale to pass costs through. But even they take the 37% GVA hit because higher input costs eat into the value they create. Small firms which have turnover under 50 crores get a different deal entirely. Input QCOs don't significantly change their production or GVA. After all, they can't pass costs through the way large firms can. Instead, profitably falls by almost half. Output side QCOs hit small firms even harder. Their GVA falls by 44% and profits fall by about 59%. For large firms, the impact on both measures is statistically insignificant. The combined effect of being exposed to QCOs on both the input and output side can completely crush the profits of small firms. But large firms more or less survive. In sectors where firms of very different sizes compete, a uniform regulation doesn't have uniform effects. Large firms can absorb compliance cost, invest in BIS certification, and negotiate with suppliers. Small firms operating on thin margins and with limited bargaining power can't. The CSEP paper cites research showing that large firms in QCO affected sectors actually lobby for these regulations because they know smaller competitors will struggle. Now, what QCOs functionally do then is accelerate market concentration. They shift market share from small to large in a sector that's already concentrated. Now, this exact same dynamic played out with steel QCOs, where large primary producers welcomed restrictions that squeezed smaller importers. Now, recognizing the adverse impacts of these QCOs, the government revoked some of them, especially on foundational inputs like ethylene glycol and terephthalic acid. But the question now is whether the remaining 28 chemical QCOs and the 100 still in pipeline across other sectors will be assessed against the evidence this paper provides. QCOs on intermediate inputs inflate production numbers while destroying value, and the burden falls on smaller firms. At the same time, they don't measurably improve the quality of output, which was their stated purpose. The broader implication of this is also worrying. Do these QCOs hurt our ability to take the advantage of China Plus One opportunity that's been touted for so long? Now, making that possibility worse is the fact that the West Asia crisis has also pushed Indian importers toward more Chinese sourcing, not less. There is also the constant flip-flop of US tariff policy hanging over our head. Now, this is hardly the story of one sector. It is broadly a feature of Indian manufacturing, where import tariffs designed to protect industry hurt its smallest firms while often benefiting large ones by affording them more pricing power. The CSEP paper is one among many other pieces of evidence that tariffs can often be too blunt a tool to boost national productivity. Now, coming to Tidbits. SpiceJet has added 3 Airbus A320 planes to its operational fleet under a short-term damp lease. The move helps the airline expand flight routes and meet rising passenger demand during busy travel seasons. Novo Nordisk filed a lawsuit against rival Eli Lilly, claiming the company uses misleading and outdated clinical trial data in its weight loss drug advertisements. The lawsuit alleges that Eli Lilly compares the highest doses of its own drugs against lower doses of Novo's Wegovy and Ozempic to make its products look superior. RBI decided to keep its key benchmark interest rate unchanged as it continues to monitor inflation levels. Analysts expect interest rates to remain stable for now as the central bank balances economic growth with stable prices. Quick commerce apps like Blinkit and Zepto are increasingly becoming the go-to platforms for buying beauty and high-end personal care products. Industry reports show that easy access to fast delivery is driving shoppers to buy more premium items through these apps instead of traditional retail stores. The state government of Odisha is drafting a dedicated gems and jewelry policy alongside a specialized industrial park. The state plans to capitalize on the rapidly growing lab-grown diamond market and build a manufacturing ecosystem similar to Surat. That's it for this episode. See you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.